everybody. Welcome to this quarter's Market Outlook and Strategy webinar. My name is Jeff Porter. I'm Chief Investment Officer here at SBSB. As always, I'm joined by the usual gang, Gary Lyons, Senior Director of Portfolio Management.
Hello, everyone.
And newly minted and well-deserved Director now in the Portfolio Management Department, Walt Knocken.
Thanks, Jeff. Good morning, everyone.
So you see the title of today's webinar, Anniversary Edition. This doesn't have anything to do with an SBSB anniversary. What we're talking about here is the 10-year anniversary of this economic expansion, which now is in record territory. So we wanted to start out by just reflecting back on the past 10 years, the major stories, the major themes, and the key takeaways for investors. And of course, you can't have an anniversary without cake. So we're going to ponder the question, is President Trump trying to have his cake and eat it too with respect to his economic strategy and getting elected? And of course, you can't have cake without presents, without gifts. So we're going to talk about the gift of bonds. Are they the gift that's going to keep on giving, or have they run their course? And lastly, we're going to talk about a change that we made to most client portfolios, increasing the allocation to emerging markets, more specifically emerging market value stocks. So if we look over the past 10 years, I think the first thing that comes to mind is not necessarily unique to this expansion. And it's the fact that those investors who ignored the noise, stayed disciplined, stayed invested, they were handsomely rewarded. And there was certainly a lot of noise over the past 10 years. You think of all the issues over in Europe. Remember Greece and the quote, Club Med countries down there. They were thinking Greece was going to exit the European Union. They were calling it Grexit, not to be confused by Brexit, which is the major issue over the past 2 years. Remember back in 2015-16 timeframe, China had a major economic slowdown. Oil collapsed by 70%. That threatened oil companies all over the world. Here in the U.S., remember back in 2011, the U.S. federal government debt downgrade and all the drama around that. It seemed like the government was shut down pretty much every year. There was a threatening of the government shutting down every year, mostly over the debt ceiling debates. And of course, the drama over the elections. So despite all this, the markets continued to churn higher and reward investors. So if you've been listening to our presentations over the years, you know that we are all in favor of risk reduction strategies or risk management, especially for those investors who are very risk averse or who are in their stage of their life where they're withdrawing from their portfolio or getting close to that period of withdrawing from their portfolio. But we rarely, if ever, advocate for big bets to cash or significantly straying from your long-term strategic allocation. So the next thing that comes to mind is a little bit more unique to this expansion. So it's so important for investors to remember that while it's the markets that set the price for assets and liabilities in the free market, it's humans that set the rules of the game. So when things aren't going well, humans work like heck to fix things. And when that isn't enough, they change the rules to the game. And that's what happened at the end of this economic expansion, or the end of the global financial crisis at the beginning of the expansion, when the government changed a very important accounting rule called mark to market. So if you remember back then, there were all these toxic assets such as mortgage-backed securities, and they were selling off fairly dramatically. That was because there was a lot of fear back then, and most investors didn't know what was inside these assets. So again, these so-called assets were on the balance sheets of banks, of insurance companies, of other companies, and they were making them look even more fragile than they already were. So on March 16th, you see the red dot there at the very bottom of the market. That was the day that the Financial Accounting Standards Board proposed giving these companies a little bit more leeway in how they value the assets. So not based off of the free market, but based off of their own internal methodology. And after a 15-day public comment period, they officially announced the new rules and regulations, and we were off to the races here. So the next time we get into difficult times for the economy or the market, it's just important to remember that human beings will pretty much do anything to make sure that prices move from the lower left to the upper right. So another theme that we wanted to talk about over the past 10 years was the repairing of household balance sheets. Isn't that right, Walt?
Yeah, absolutely, Jeff. And what we look at here is two key data points that show that consumer finances and their balance sheets have really strengthened over this expansion, especially over the last 10 years. So what we see on the right-hand side is household net worth, and that's in billions of dollars. So we can see that peaked in the third quarter of 2007 at just under 70 trillion. And then you saw that come down during the great financial crisis to about 50 trillion. So a significant decline there. And then ever since, with the markets rallying, you've seen household net worth over nearly double over this time period. So as of 3/31/19, it was just under $110 trillion. And really what this shows is the power of this current bull market and the gains that we've seen and U.S. households have seen on their balance sheet. And why this is important is that consumer spending makes up about 2/3 of GDP in the U.S. So a healthy consumer means a healthy U.S. economy. And that's what we've really seen over this 10 years. On the left-hand side, we look at the household debt service ratio. So this is debt payments, think credit cards and auto loans, as a percentage of disposable personal income. So the income you're taking home after taxes. And what you can see is that in the fourth quarter of 2007, prior to the great financial crisis, the last peak, consumers were a bit over-leveraged, right? That was one of the big stories of that mid-2000s bubble, housing, and then an over-levered consumer. So you can see that was 13%. And since then, it's come down to under 10%, which is actually the lowest level it's been since the early 1980s when looking at this chart. So what are the main takeaways? The consumer is not over-leveraging themselves. They're actually cleaning up their balance sheet and finances. And overall household debt has actually decreased, as Gary will discuss a bit later on. And another reason why this debt service ratio has come down is really important. And that's the fact that if you look from 2009 to 2011, the Federal Reserve played a large role in this. They dropped interest rates to zero. And it was about over 500 basis points of cut of 500 or so basis points there. And as such, if you're paying a smaller rate on your loan, the percentage will drop down. So that's where you saw the significant decrease. Another factor has been inflation, and inflation has remained low. So one of the other takeaways here and the trends that we saw when looking back over the past 10 years is really, where has inflation been? It's perplexed the Fed, and it's perplexing us here in the room as well. But there are a couple key attributes, and one of them being apps. So the iPhone was actually invented and released in 2007. It's hard to believe that it was only 12 years ago. And since then, it's driven costs down that you don't really notice. So Google Maps, you're not paying for directions anymore at all. It's right on your handheld. Uber, I'm not paying $80 to go 10 miles to the airport anymore, and Uber has cut that cost in half. You have a professional camera on your phone. You're not going and developing pictures or paying for a very expensive camera these days. Another trend is obviously the Amazon effect. And right there, that really minimizes overhead costs for any company to do business. With a flat globe, meaning you can go anywhere to lower those input costs there and bring the overall cost down. As a consumer, this is great. I can compare prices on a product across 5 different vendors in 15 minutes sitting from my couch. So this has really hurt the brick and mortar mom and pop stores, and that's what we've seen. We've seen the trend of kind of those death of the classic mall shops there. And then lastly, you have the YouTube videos. So Gary and I have cracked a ton of jokes here. You need to probably buy more insurance to do these. But if you feeling risky and you don't want to pay the $500 to $1,000 for a handyman to come over, you have all the directions right there to try to fix your plumbing problem there. So Gary, another big story of the past 10 years is that although it's the longest expansion, given that we're celebrating 10 years, it's actually been one of the weakest.
It certainly has, Walt. And so here we see plotted post-recession cumulative real GDP growth for each previous U.S. expansion. That's there on the y-axis. And then the number of quarters that the expansion lasted is on the x-axis. And you see there the dotted black line. That's the current expansion, and it's now the longest ever. So based on the elapsed time since the last recession, the U.S. looks due for another recession. However, as you said, Walt, this U.S. recovery has been exceptionally weak in terms of real GDP growth. Previous growth cycles in the U.S. have had 42 to 91% cumulative GDP growth. The U.S. is now just reaching 41% cumulative growth in real GDP. So if the U.S. were to have the historical average 73% cumulative real GDP growth in this expansion cycle and at this expansion rate, then the U.S. could have another 6 to 8 years before the next recession, especially if rates stay low, and they are low, and it looks like they're headed lower.
So Gary, what's the reason you think of why the GDP has been so low and thus why interest rates could stay low?
Yeah, Jeff, there's a number of reasons. One of them is there on the left. You see the demographic headwinds that are slowing U.S. growth. And the equation is basically growth in workers, that's there in blue, plus growth in real output per worker, that's in green, equals growth in real GDP. That's the figure in orange. And as you can see there, real GDP growth has been steadily dropping 40% since 1978. Now on the right, we see growth in working age population, and that's the percent increase in civilian population ages 16 through 64. Look at the drop in 2009 through 2018, and even more importantly, the census forecast drop 2019 to 2028 there on the right. That's an 85% cumulative drop. So demographics are a serious headwind to future U.S. growth.
And it's not just demographics, it's the other big D, right, which is debt.
That's right, Jeff. Debt is huge. So here on the left, we see the U.S. debt to GDP ratios as a percent of nominal GDP. The government is there in gray/black, and it's at 97.2% debt to GDP. Households, as you were mentioning, Walt, have done a great job of bringing their debts down. They're at 76.4% debt to GDP. That's there in the light blue line. But non-financial corporate debt is still growing. So you see there 73.9% debt to GDP. That's the dark blue line. The chart on the right shows BAA corporate debt. BAA debt is the lowest credit rating issued by Moody's for investment grade debt. And as you can see there, it's at its highest level in 20 years at 50.3%. So demographics and debt are both strong headwinds to U.S. growth. And they are why the current expansion is proceeding so slowly.
And it's this surge in corporate debt that has made United States stocks trade more like a commodity rather than being linked to economic fundamentals or even earnings. So you see to the right here, it's another debt chart. This isn't a ratio of anything. It's just the total corporate debt. And you can see coming out of the global financial crisis, debt went down till around 2011, 2012 timeframe, and then it hooked up and surged, and now it's at a record high. So the question is, what did they do with all this cash that they borrowed? Well, one of the major things they did was buy back their stocks, which you can see here over on the left, which is a chart of the number of shares outstanding for S&P 500 companies. So again, you look coming out of the global financial crisis, the number of shares increased. So that was when companies were trying to raise money to stabilize their businesses. But then around 2011, 2012, no coincidence, this hooked back over and has dropped significantly to the point where the shares now outstanding are at a 19-year low. So what you've had here is just a major debt for equity swap, and Econ 101 tells us when the demand outweighs the supply, then prices are going to go up. And this has just been a huge tailwind for investors over the past 6 or 7 years. And if rates remain low, this could continue to help investors. But at some point, corporations are going to need to shore up their balance sheets. They're going to need to cut debt. And at that point in time, this tailwind starts to die down, or it even might reverse. So everything we're talking about here with debt and interest rates and markets, it all comes back to one place, which is central banks. And this is the last thing we wanted to talk about in this section, which was, past 10 years have been the new era of global central bank policy. And stocks have become very reliant, not only on the Federal Reserve, but the European Central Bank, the Bank of Japan, etc. And I think this chart illustrates this point nicely. So you have in red the Federal Reserve's balance sheet. And this line goes up when the Federal Reserve buys bonds and pushes cash out into the system. So then you have in blue the S&P 500 stock price, and you can see how tightly correlated they are. So if you look towards the left part of the chart in late 2008, we're right in the middle of the crisis. That's when the Fed's balance sheet spiked higher, and soon after, the S&P 500 bottomed. You see when the balance sheet has flattened out, the stock market has had some issues. It's gone flat. It's been very volatile during those periods. Now, the one place where it starts to diverge is late 2016, 2017 timeframe. And the reason for that is that the other central banks who were late to the party came to the party. So the Bank of England, European Central Bank, the Bank of Japan, other banks in the emerging markets, they started really ramping up their balance sheets at that time. That trickled back to the United States and helped the market there. And lastly, you see the upper right-hand corner, that red box. That's when the Federal Reserve tried to normalize policy, tried to reduce its balance sheet, and lo and behold, the market had a tizzy and has had a rough ride during that period. So, what will happen from here? How will the Federal Reserve unwind this? That is a topic for a whole other webinar or multiple webinars. But I will say this, that central banks have done so much work and have thrown so much at the system that whenever we do enter into the next downturn, they will likely have less ammunition than in the past to kind of fight that battle. All right, so as I mentioned before, you can't have an anniversary without cake, and this section is a little bit tongue-in-cheek, but we wanted to ponder the question, is Donald Trump trying to have his cake and eat it too with respect to his economic strategy and getting elected? So, Walt, what might that strategy be?
Yeah, absolutely, Jeff. And I'd like to preface these next two slides with Warren Buffett's famous quote on politics and how he thinks about politics and elections. And he said, "Don't mix your politics with your investment decisions." And I think this is very important for all of us to keep in mind, as we've seen over the past 3 elections, the negativity that sometimes surrounds what's going to come up. But as we mentioned before, it's very important to stay invested. Time in the market is your friend, not timing the market. So this slide really shows our take and our guesstimate on what's Trump's game plan to get reelected over the next 15 months. And what we saw in the rally over the first 4 months of the year was not only the Fed's pivoting in their monetary policy, but there was a lot of growing optimism over U.S. and China successfully coming up with a trade deal. But then in early May, Trump seemed to reverse course, and he really started to play hardball with China. And we believe it's because of the recent improvement that we saw in the economy and the stock market rally that we saw over the first 4 months of the year. So he had some breathing room to negotiate a bit. And what this has done, given his rhetoric, is it seems like it's going to force the Fed to lower interest rates and what has been deemed as insurance cuts, given that this ongoing uncertainty with global trade policy has put downward revisions on economic growth across the world. Now, when we look ahead over the second half of 2019 and as he enters the election year in 2020, what he would ideally like to do, we think, is make a deal with China after the Fed cuts rates. So then all of a sudden you get a market rally from both a dovish Fed and a successful trade deal on the U.S.-China front. Now, what happens, and when you're playing with fire a bit, is the risks associated with this. And this shows the New York Fed probability of a recession looking 12 months out. And what we see here is that it is sneaking up on its from its levels in mid 2007 or so, which is at that 30. And what we've talked about internally here is that 30 mark, when we look back over the past 3 cycles, has been a pretty clear indicator of trouble and waving that red flag. And just as I mentioned before, the risk of all this global trade uncertainty is that corporate CEOs don't know what to do. Should they be investing? There's just a lot of uncertainty. So it makes everyone hit the pause button. And as such, global economic growth forecasts come down, recession risks rise. So what Trump is trying to do, just like the Fed, is walking this pretty thin line where he's trying to get his way with China, trying to get the Fed to cut rates, but also trying to avoid a recession in 2020, which would be a disaster for his chances of re-election. So, Gary, we've seen a lot of volatility in the fourth quarter in May of this year. This has not been a straight recovery back up to new all-time highs. So it really shines the importance on the power and role that bonds play in the portfolio, right?
Absolutely, Walt. Bonds are extremely important in the portfolio. So one of the things we've so often discussed in these webinars is the inability to consistently predict economic variables shorter term. And on this chart, we see yet another incidence of that. This is the survey of analysts' interest rate predictions from January. Each one of those orange lines with the red dots is an analyst's prediction of where yields on the 10-year Treasury would progress to by June 2019 and then by the end of 2019. Now look closely at the black line showing where yields actually are. Not even close. That's 50 of the top analysts making those predictions. In fact, the survey from which this data comes shows no analyst saw the recent rush into government bonds coming. Back in October, when yields on the 10-year Treasury were near their peak of around 3.2%, none of these more than 50 economists predicted yields would dip below 2.75% by June 2019. The average forecast was, in fact, 3.39%. You see there the actual yield is about 2%. Again, not even close.
And when you see that yield drop so much, that means great returns for investors in bonds, right?
Absolutely, Jeff. So here we see the performance of the world stock market index, the dotted blue line versus the U.S. Treasury bonds, the green line from June the 15th, 2018 to June 18th, 2019. For that time period, that MSCI All-Country World Stock Market Index had a total cumulative return of 2.33%. But look at quality bonds like the 7 to 10-year Treasury Bond Index. That had a total cumulative return of 10.18% over the same period. And that's why we have bonds in your portfolio. There are plenty of times when bonds return more with far less volatility, and this allows us to keep volatility down in client portfolios while keeping returns up. So bonds often are a gift in that way.
Absolutely, and if you've been listening to our presentations over the past year or so, you know that we've been increasing the quality of our bond portfolios. Essentially, we're throwing a stronger safety net around the money that you may need in the next 5 to 10 years. For those of you who aren't withdrawing from your portfolio, you can think of it that we're increasing the diversification and the potential benefit of rebalancing, because if the stock market continues to have some issues, we would fully expect quality bonds to really have a thrust up in price, similar to what we see here. But what about that money that you don't need for a long time, 20, 30, 40 years, or this money meant for heirs? It's this portion of the portfolio where we've actually increased the volatility, really starting about 2.5 to 3 years ago, when we've inched up our exposure to international stocks, namely emerging markets. And over this past quarter, we again adjusted up our exposure to emerging markets. This time, we sold international developed stocks to fund these purchases. So whenever we're thinking about decisions, at the heart of those decisions are the asset class long-term return expectations. So you've seen this chart numerous times. Again, this is the expected 10-year annual returns for the major asset classes. You see here in the left, United States bonds, the midpoint estimate at 2.4%. In green, U.S. large company stocks, midpoint estimate not too much better at 2.7%. Certainly there's a range around that. International developed stocks at 7.4%. And the highest expected return over the next 10 years is emerging market equities with a midpoint of 9.2%. So you see the x-axis down at the bottom, the expected volatility. Certainly stocks have more volatility than bonds. So the question is, what do you do with that volatility? How do you use that volatility? So if the long-term expected returns are low and you get volatility to the upside, well, that's an opportunity to rebalance, to take profits, or to reduce your target percentage in that asset class, and vice versa. If the expected return of that asset class is very high and you get volatility to the downside, that's an opportunity to rebalance and buy more shares or increase your target percentage to that asset class. So we're not using this trade war as an opportunity to exit emerging markets. We're actually using it as an opportunity to pick up shares slowly that we think are going to benefit over the long term. Now, that doesn't mean that we completely ignore what's going on in the short term. For example, with this move, we know that in the first quarter of this year, China enacted a massive stimulus program that should hit the economy kind of now and going forward over the next 6 months to a year. We also know that we might be embarking on another cycle where the Federal Reserve might be cutting interest rates. So, Walt, why is that important?
Yeah, absolutely, Jeff. And there's a lot on this page, so let's unpack it a bit. And we'll start on the left-hand side. And what this shows is the relationship between emerging market equities and the U.S. dollar. So the U.S. dollar is that purple line. And when that is increasing or going higher up and to the right, the U.S. dollar is weakening. And when it's coming down, it's strengthening. So you can see the scale there on the right-hand side. It's a reverse scale. And then on the left-hand side, or the gray line, is emerging markets' relative performance to developed markets. So, as we see, when the U.S. dollar is weakening, emerging markets are performing well on a relative basis, or outperforming. And we saw that in the last period between 2002 and about 2007. That's when we saw the last period of real outperformance by emerging market equities, and that coincided with dollar weakness. Then what has happened over the past 7 or 8 years is the exact opposite. The U.S. dollar has strengthened considerably, and given that headwind, emerging markets have underperformed their developed market peers. So what we see here is this reverse relationship where the U.S. dollar increases, emerging markets underperform. The U.S. dollar decreases, emerging markets outperform. We call that the inverse correlation, and that's seen by that green box in the middle of the chart there. So if we move to where do we think the U.S. dollar is going to head over the next few years, the Federal Reserve, as we mentioned a couple of times and Jeff just mentioned, plays a huge role in that. So this chart shows the federal funds target rate in blue. So we can see the Fed rate hike cycles and the Fed easing cycles. And let's focus going back to the right-hand side of the chart. From 2005 to 2009, that's where we saw the Fed hikes stopping in about 2007 and then cutting all the way down to the zero bound during the height of the great financial crisis in 2009. And it stayed at the zero bound there until December 2015. And since then, they've hiked 9 times, with their last hike in this past December. Now, the red line that closely tracks that federal funds target rate is the dollar index, so the performance of the dollar. And here, a rise is strengthening, and when it goes down, it's declining. So what we've seen during this Fed rate hike cycle is that dollar appreciating. And so now that the Fed has reversed course and maybe venturing on its next easing track, that should put downward pressure on the U.S. dollar there. So what's the main takeaway? Fed tightening is an increase in the U.S. dollar, strength in the U.S. dollar, and therefore a headwind for emerging market equities. Now, on the flip side of that, Fed easing should make the U.S. dollar decline or put downward pressure on the U.S. dollar, and therefore that should be a tailwind for emerging market equities moving forward.
So these are some of the reasons why we increased exposure to emerging market stocks, but more specifically, we added to emerging market value stocks. Gary, can you just comment on that?
Absolutely. So on the chart here, that dashed black line is the average cost you pay for value stocks historically. And as you can see there, in all world regions, value stocks are much cheaper than their historical averages. U.S. value stocks, there in light blue, are 21% cheaper than historical averages, followed by European stocks, there in gray, 36% cheaper than historical averages, and emerging market value stocks in dark blue, the cheapest of them all, a 41% discount to average historical costs. And that's why we've been adding to value stocks internationally, and especially value stocks in the emerging markets. Value is one asset class we think is now poised for historically exceptional returns, and Jeff, especially in the emerging markets.
Absolutely. Thank you, Gary. So let's wrap up with just a few summary points. We started off by talking about the 10-year economic expansion. It's obviously been very rewarding for investors, and it's great that we fixed a lot of the ills of the economy. Unfortunately, there are a few longer-term issues that haven't been resolved, namely debt, which has actually gotten worse. So I would fully expect the big theme over the next 10 years is debt's impact on the economy and markets, and how our policymakers are going to deal with that. As Walt was talking about, the stakes are getting bigger in this trade war with China, because a number of economic indicators are increasing or showing the increasing risk of recession. So we're hoping that this will be resolved shortly. We wouldn't necessarily bet on it, but we sure hope so. Bonds, as Gary was talking about, they have played a wonderful role over the past year or two. They provided a nice cushion to investors, reducing the volatility of the overall portfolio, but also they've generated wonderful returns. So while the yields have spiked down and they may have gotten a little ahead of themselves there certainly is a case to be made with rates going lower, and potentially even significantly lower. You think about the recession risks, central banks easing now, and there are $13 trillion of negative yielding debt in international markets. So certainly a case that rates may go lower even from here. And lastly, of course, we maintain our strong conviction on emerging market equities over the long term, and we're using short-term weakness to either rebalance or add to those positions.
So thank you all so very much for joining us today. We so very much appreciate our clients, and we're always happy to talk with you. Call me, call Jeff, call Walt, or call your service team if you need to discuss anything, or if you just want to comment or have a question. We always enjoy hearing from you.
Thanks a lot.